Let's discuss some of the challenges that we face while implementing the hedging strategies. The first challenge is misunderstand risk. So you can only hedge your position well if you understand your risk well. So if you know that there would be volatility in the steel market, you will be able to hedge it. But if there wasn't any volatility as such, so you expected the steel prices to increase from $90 to $150 in 1 year, but it actually declined from $90 to $70 per unit. So since you did not understand your risk well, you will end up losing money on this particular steel product hedging. And of course, this steel is considered to be one of the raw material in your product, so you will end up booking losses on your bottom line as well. So one of the main challenges to understand the risk well and do the risk mapping right. So you should know when do you require your hedging, the maturity. You should know what is that product that you need to hedge. You should know its location if you are dealing with the physical delivery of that particular product. So risk mapping is key. And if you misestimate your risk, you'll be leaving your. On the other hand, if there was a risk and you did not see it, if there was a volatility in the steel market and you were expecting the prices to decline from $90 to $70, but it actually increased from $90 to $150, then it will lead to unhedged risk position as well. So you did not expect the steel price to increase further and you did not hedge it, and you may end up losing money through your unhedged position. So understanding the risk is critical. Then there's this challenge of market trend change. So we will further discuss in later slides about the dynamic risk management or dynamic hedging strategy. But the thing is that market trend keep on changing. So you may see that dollar to euro parity for a period of time, the dollar is appreciating, and you make your positions while assuming that it will keep up appreciation, but something happens in the market and then the dollar start depreciating against the euro. So the change in the market dynamics will lead to some losses or to some unhedged position. So it would be too difficult for the firm to keep changing on their risk management strategies, but that is considered to be one of the challenges that they face while implementing risk management strategies. The third example is of poor communication. So we talk about risk management process, that what is that product that you need to hedge, when do you require it, what's the location like. So if there are multiple parties involved in communication, for example, if there is a bank and then there is the subsidiary, and if its positions are linked in some way or another, then you may face some sort of issue if the communication is not right. So if the hedging strategy is not communicated effectively, we can have issues with the decision making. An example of it is MGRM. MGRM was a refinery which was a subsidiary of Metallgesellschaft AG. So what happens is that it actually happened in 1993. So basically MGRM had commitments which were long term. So they had taken money from customers to deliver 150 million barrels of gasoline and heating oil spanning over a 10-year period. So it was a long-term commitment. And what management choose short-term product, short-term rolling product to hedge this position for a long term. They did it in the OTC swap, in the over-the-counter swaps, and when there were significant changes in the oil market, MGRM parent company lose all hedging positions because its MGRM exposure was linked to the parent company, and because of the miscommunication between the parent company and the subsidiary, the parent company actually booked significant losses when there was a change in the oil market. The next challenge is that there should be availability of specific skills and expertise. So hedging requires very specific skills, knowledge, research and time to be able to execute those transactions. So the availability of that sort of characteristic, that sort of skill always remain a challenge. Luckily, there are certain organizations which also provide consulting to be able to assist organizations in conducting the hedging practices. Again, it depends on the size of the organization. If the organization is a bank, they will have their in-house capacity because hedging would be considered as one of the critical aspects of their risk management strategy. Now let's talk about how do we deal with those challenges. So one answer to all of these challenges is that we can deal most of the challenges if there is a strong risk culture. So if the people in the firm are aware of the risk management practices in the organization, and if they are concerned about the limits and about monitoring and following the limits that we have set, then most of the challenges will be automatically improved. But there are a number of steps that we can take in implementing or in improving the risk culture. Number one is again strong risk communication. So the management, either within department or between parent and subsidiaries, should communicate risk goals very openly and in a brief and in a clear manner. So if there was this communication by the parent company that the subsidiaries are supposed to hedge long-term position with long-term instruments, it should not have been a problem with the MGRM. But since the goals were not communicated and there were not any potential warning signs and risk limits, it happened. So if there are limits, if there are warning signs, the organization should be serious about the breaches. Who would be monitoring the breaches? Who would be responsible for communicating those breaches? Who would be responsible for taking it to the board audit committee or board risk committee? And what do they do with those breaches? So the communication plays a significant role in addressing most of the challenges with hedging. The second aspect is that there should be a strong training culture. So the firm should conduct trainings to ensure that key staff actually understand what risk management goal is. So you have set limits, you have introduced it in the system, dealers are supposed to follow those limits, but you have not explained them that why you have introduced such sort of limits and what is the advantage of abiding by those limits. So if you haven't done so, you will be facing challenges in implementing your strategies. The third point is that the staff should understand the impact on limit breaches. They should know that what would be the potential consequence if risk limits are breached. There should be a concept of soft and hard limits. There should be a mechanism for reporting, and the breaching of limits should not be taken lightly. So if there are limits in place, the staff should be aware that the limits are introduced to be able to save them from a certain loss, and the impact of those limit breaches should be significant enough to assist the line managers to abide by them. The last point is that there should be identification of top 10 risks by the board of directors. So they should identify it. Ideally, they should also disclose it to the external stakeholders through annual report. If it comes from the board of directors, if it comes from the top, then both the internal and external staff actually consider it to be critical. Now let's talk about how do we hedge operational and financial risk. So whenever we are doing hedging, the firm has to ensure that they are hedging both operational and financial risk. Some of the critical risks that we'll discuss are pricing risk, foreign currency risk, and interest rate risk. So if we talk about the income statement risk, income statement is something that is considered to be operational in nature. It's focused more towards covering a firm's activities in productions and sales. It has to ensure that if the company is manufacturing cars, it has all the raw materials available to be able to produce the car in the desired level of cost. So the income statement risk is something that has to do more about the P&L of the organization. On the other hand, the balance sheet risk is something which is mostly financial in nature. So we are talking about the assets, we are talking about the liabilities. If it's a bank, there will be financings, there will be investments. So how the organization is actually dealing with the risk of lending money to counterparties, how it's dealing with the investment in different financial markets. So basically the firm should be concerned, the bank should be concerned about managing or hedging both income statement risk and the balance sheet risk. When we talk about hedging operational and financial risk, the first risk that we can discuss is pricing risk. So pricing risk is mostly related to the cost of input. If there is a raw material which constitutes 20% of cost of goods sold, then the firm should be concerned about hedging this raw material, especially when there is volatility in the prices of this particular commodity or product. We have to hedge it because this volatility can bring a lot of impact on the firm's ability to conduct its business or to remain competitive with its peers. Firms usually manage this risk through forwards and future product, which is a derivative product again. The second risk is foreign currency risk. So the firm may lose money or revenues due to fluctuation in the foreign exchange market. We're talking about firms, especially multinational companies who have offices in, let's say, 10 countries. So if they are moving money from one country to another, if they are purchasing raw material in one currency and producing the product in another currency, then the risk of foreign currency remains there. Generally, forward contracts are used for hedging foreign currency liabilities. In some of the cases, there is a case of natural hedging as well. So there's a company in the US and there's a company in China. So there is some cost involved in there, but there are liabilities in assets, and opposite to it there are assets in China. So if there are assets and liabilities in opposite position, there is some natural hedging that is available for the multinational companies, and they may just hedge the net position which is open in the market. The third risk is interest rate risk. So whenever we are going in the financial market, whenever we are investing in bonds or we are taking positions, we can face losing money or positions if there are undesired changes in the interest rate. So in practice, we use interest rate swaps for safeguarding the firm from unusual or undesired changes in the interest rate. The main objective again of hedging interest rate risk is to control the firm's exposure from unfavorable interest rate fluctuations. Now let's talk about two broad concepts in hedging. So we have discussed hedging, we have talked about the challenges and how can we face those challenges and what are the broad products where we can do hedging. But let's discuss what are the two broad ways of hedging. So there are two ways: dynamic hedging and static hedging. So dynamic hedging is the hedging which is considered to be ideal. So Basically, first you have done your hedging. If there is 100 million exposure, you have taken your position, your opposite position, to hedge your position completely. But if in a week your exposure changes from $100 million to $110 million, then you would be increasing your position to hedge your position completely. So in a dynamic hedging, you keep on changing your hedging positions to be able to exactly match your positions. This method is of course complex, and it is also costly, because doing every transaction is costly. You will have to have experts who will be dealing with this sort of arrangement, and then you will have to be very proactive in managing your risk. On the other hand, there is this concept of static hedging, which is comparatively a straightforward exercise. So basically, the risky investment position are initially determined, they are hedged, and we don't make any further changes during the maturity of the position. Of course, if we have a timeline of 3 months, if we have done hedging here, there would be no change during the maturity. But in case of dynamic hedging, if there is a 3-month period and we have hedged it here, we may change it here again, and we may change it here again, and if there are significant changes, we may be changes in between as well. So the dynamic hedging is something that is continuous, and we keep on changing our position based on the changes in the financial markets. Then we discuss the hedging considerations. So there are a number of points that we have to take care while doing the hedging. Number one is time horizon. This is something that we discuss in risk mapping as well. So the firm should ensure that we have relevant time horizons while doing hedging, and we have to show that our valuation are exactly matched with the time horizon. So we just discussed the hedging during 3 months. So if we have a 3-month exposure, it should ideally be matched with a 3-month exposure. The example that we discussed earlier, the MGRM, they had issue with the time horizon. Their maturity, their duration was of 10 years, but they were using a 1-year product for hedging it. And of course, there was this mismatch, a huge one, and it led to losses. Then you also have to deal with the accounting issues. So the organization will have to manage complex financial accounting implications, because you are dealing with derivatives which has both long and short positions, which ideally should be net off to zero. There should be no open position in the market in your books. So you need experts, and of course these treatments vary from jurisdiction to jurisdiction. The jurisdiction in the US may differ from the laws in Canada. So if you are dealing with a multinational company where there are operations in multiple markets, then you have to be very concerned about the accounting issues. Then we have taxation. Of course, it's similar to accounting. So we have to consider what sort of practices that we will have to follow for your tax environment. If you're operating in the Middle East, the tax is very low. It's zero in some of the states as well. But if you have moved your operation from Middle East to the European market, then the tax would be significantly higher, and hence the pricing should also account for these changes as it can impact the cash flows significantly.